Everyone keeps asking me the same question right now. Where should I invest in Perth? And I think it's the wrong question. The question should be, should you even be investing in Perth at all? Because when I ran my framework across Greater Perth, the data told a very different story to what most people expect. Most of the market is showing signs of a slowdown. There is an increase in supply, rising discount rates, and falling demand. The peak in most locations has passed. Now that doesn't mean Perth is crashing, it's not. But the era of buying anywhere in Perth and watching it go up is over. And I think a lot of investors haven't accepted that yet. They're still looking at Perth the way it was 18 months ago, and the market has moved on. The opportunity is still there, but it's narrow. And when I filtered everything down, I found just 2 pockets where the fundamentals are genuinely still holding up. So let me show you what I found. When I assess any property market, I use a supply and demand framework. And the reason I use it is because it removes emotion from the equation. So here's what I filter for. I want to see a median price within a specific range that makes sense for the investor's budget. I want vacancy rates sitting below the national average, which right now is about 1.5%. I want a gross rental yield of at least 4%. And I want to see low stock on the market, because when there's limited supply available for sale, that puts upward pressure on prices. I also look at owner-occupier rates because I want areas where the majority of people own their home. That tells me people are choosing to live there, not just rent temporarily. I look at public housing concentration and I want that below 5%. I look at forecasted population growth and I want to see at least 1% per year over the next decade. And one of the big ones for me is industry composition. Because if any area is heavily reliant on one industry, say mining, then your property's performance is tied to that single sector. If mining slows down, jobs leave, population drops, demand drops, and you're left holding a property in a declining market. So I want to see diversity across industries like healthcare, education, trades, and professional services. When you have multiple industries supporting the local economy, if one sector softens, the others can absorb it. Now, when I applied all these filters across Greater Perth, the shortlist got very small very quickly. We started with the entire metro area and ended up with just 2 pockets. Let's start with the first one. The first pocket sits about 20 to 30 kilometers north of the Perth CBD in the Wanneroo corridor. There are 3 adjoining suburbs called Hocking, Sinagra, and Clarkson that I want to show you. I'll start with Hocking. The median house price is $875,000. It's grown just over 50% in 3 years and almost 80% in 5. The vacancy rate is 0.87%, which is below the national average. Properties are selling in 10 days and the gross rental yield is sitting at 4.16%. But the number that really stands out is the stock on the market. There are currently 4 properties listed for sale in the entire suburb. That gives you a stock on market percentage of 0.16%. To put that in context, anything above 2% is where you start getting cautious about oversupply. So what is this telling us about Hocking? It's telling us that demand is significantly outweighing supply. When you've got properties selling in 10 days and only 4 listings in the entire suburb, buyers are competing for limited stock. That competition is what drives prices up. And with vacancy rates under 1%, the rental side is just as tight. Landlords aren't struggling to find tenants here. Tenants are struggling to find properties. That's the kind of imbalance you want to see as an investor because it protects both your capital growth and your rental income. Right next door, Sinagra is telling a similar story, but with even stronger short-term momentum. The median is $891,000. It's up almost 11% in the last 3 months alone. And over 5 years, it's grown 93.7%, with a 5-year annual growth rate of 14%. Vacancy is the same as Hocking at 0.87%, and days on market is currently sitting at 11, with the yield sitting at 4.49%. What stands out to me about Sinagra is the acceleration. That 11% growth in 3 months tells you that buyer activity is intensifying, not slowing down. And when you combine that with a vacancy rate under 1% and properties moving in 11 days, you're looking at a suburb where both the sales market and the rental market are under genuine pressure. And then right next to those 2, you've got Clarkson. Now, Clarkson sits a little further out at 32 kilometers from the CBD. It's got a bigger footprint than Hocking and Sinagra, with a population of almost 14,000 and around 5,600 dwellings. The median house price is $785,000. It's grown almost 73% in 3 years and over 109% in 5. The 5-year capital annual growth rate is sitting at 15.92%. Vacancy, 0.77%, which is actually the tightest of the 3 suburbs. Properties are selling in 12 days and the gross rental yield on houses is 4.57%. But here's where Clarkson starts to separate itself. There are currently 26 properties listed for sale across the entire suburb, which gives you a stock on market percentage of 0.46%. And that listing number has dropped 62% in the last 12 months alone. So you've got supply falling off a cliff while buyer demand keeps climbing. The potential buyer's demand metric is sitting at 971, which is classified as high online demand, and it's up 183% in 5 years. The demographic profile backs it up as well, 67% owner-occupier rate, and that's been trending upward every census since 2011. Public housing concentration is at 3.25%, which is still within that range I'm comfortable with. The top industries are hospitals, aged care, and retail. So you've got diversity across that healthcare and services rather than reliance on any single sector. And the crime score is 10 out of 100, which is very low. The other thing I want to flag here is the development pipeline. House approvals in the Wanneroo local government area have been running strong, with over 3,400 in 2025. But those are being absorbed across the entire council area, which covers a massive growth corridor. When you zoom into Clarkson specifically, there's very little greenfield land left. So the suburb itself is largely built out, which means the supply constraint you're seeing in those listing numbers isn't something that's going to reverse easily. The second pocket takes us south, about 41 kilometers from the Perth CBD, into the Rockingham area, a suburb called Safety Bay. Now, if the Wanneroo corridor is the growth engine, Safety Bay is the most accessible entry point. And for a suburb at this price point, the fundamentals are holding up remarkably well. The median house price in Safety Bay is $780,000. It's grown 9.51% over the last 12 months, 56% over 3 years, and 87.39% over 5 years. The vacancy rate is 1.18%. Days on market is sitting at 14, and the gross rental yield is 4%. There are currently 5 properties listed for sale in the entire suburb, which gives you a stock on market percentage of 0.14%. So what does that tell us? At $780,000, this is a suburb that has delivered strong capital growth without entering that premium price territory where affordability starts to work against you. The stock on market percentage at 0.14% is actually the lowest of the 2 pockets I've covered today. 5 listings in a suburb of nearly 3,500 dwellings, that is an extremely tight market. The demographic profile supports it as well. 78% of residents are owner-occupiers, and that number has been climbing every census period since 2001. The top industries include primary education, hospitals, and defense, which gives you that diversity of employment I talked about earlier. So you're not exposed to a single sector driving the local economy. And at $780,000, Safety Bay gives investors something the Wanneroo corridor suburbs don't quite offer at the same level. A lower entry price paired with 0.14% stock on market. When supply is that constrained relative to the size of the suburb, even modest demand keeps upward pressure on prices. So that's the data across both pockets. If you're looking at Perth right now, or you're trying to figure out whether it still makes sense for your situation, I'm happy to have that conversation. I do a free strategy session where we look at your goals, your numbers, and where the data actually supports what you're trying to achieve. Link is in the description, and if this changed how you think about Perth, or you just want more deep dives like this, subscribe. I put these videos out regularly. Thanks again, I'll see you in the next video.